Dear ladies and gentlemen, welcome to the conference call of Moneta Money Bank regarding full year 2023 financial results. Please note that this conference call will be recorded. This event will have a live presentation followed by a Q&A session. As a reminder, all participants will be in listen-only mode. Today's speakers are Mr. Thomas Spurný, Mr. Carl Norman Fecht, Mr. Jan Frischet, and Mr. Andrew Gerber. May I now hand over to Mr. Spurný, who will lead you through the conference call. Sir, please go ahead.
Good morning, ladies and gentlemen. I have the pleasure to open today's presentation of our 2023 result and coverage of the fourth quarter of the previous year. If I may ask you to turn attention to page number 2, where we have the key highlights of the full year. Last year, Moneta generated net profit of 5.2 billion crowns. We have slight improvement or stability, if you will. Against the previous year, we performed at a level of 0.3% better. The net result translates into earnings per share of 10.2 crowns per share. And on the basis of the result, as well as strong capital position of the bank, we intend to propose the general shareholder meeting dividend distribution of 9 crowns per share. 9 crowns per share constitutes more than 12% increase against the dividend paid with respect to 2022. Additionally to that, we had a relatively good year. If you look at the size of the bank, the organic growth brought expansion of more than 18% with respect to the overall asset base of the bank. Our tactical posture on the market was very much geared towards deposit gathering. Hence, the funding base of the bank expanded by 20% to the level and reached the level of 415 billion. As anticipated in February 2023, we were concerned regarding economic contraction in the Czech Republic. We tightened credit standards, and we forecasted that the portfolio will be kept, the lending portfolio will be kept at a stable level, which is the reality. We came back with 263 billion in performing loans, or contraction of 2.1%. If we then look at page 3 very briefly, last year in February 23, we published guidance. Here we have the results against that guidance. We believe we have met it in all categories. We could discuss that the operating expense in a granular view is 5,732. So there is a slight overrun against the minimum target. Nonetheless, given the circumstances of last year, namely the inflationary pressures, we think this is a satisfactory result. With respect to return on tangible equity, we deliver 18%, which is above the target that we have committed to. Now, if I can turn attention to the operating environment, brief synthesis. On page 5, we have a quarterly view of the GDP, both in absolute and relative terms. Overall, the year, the estimated contraction is at level of 40 basis points, which is somewhat below what we had expected for the year. We thought the contraction would be more significant. If you look at the quarterly view, the fourth quarter came in at 20 basis contraction. For the upcoming year, we expect that the GDP will grow at 1.5%, and this is contained in the guidance assumptions that we will cover later. If we look at the government debt and public deficit, you see third consecutive year of public deficit coming down from very high level at COVID and post-COVID period. So the consolidation of public finance is ongoing, and it had also been reflected in so-called consolidation package, which the current government was able to pass through legislators. The economy also continues to enjoy nearly full employment based on the Eurostat methodology. The unemployment level is at 2.7%. Therefore, we are slightly skeptical with respect to the growth capacity of the Czech economy in the upcoming year. On page 6, we provide a brief summary of inflation and interest rate environment. If you look at last year's inflation, double-digit figure of nearly 11% or 10.7 to be specific, with the December inflation reaching nearly 7% or 6.9. So clearly, the message is positive. The inflation is coming down. It should come down quite considerably throughout 2024. In the table below, we show you the key contributors to inflation on both annual and December basis. So the positive news here is that namely food and beverages price increases have been arrested and are abating. We still face housing and energy increase in December, which is not surprising. I would say the positive expectations coupled with the decrease of inflation, namely throughout the fourth quarter, resulted in market optimism with respect to medium and long-term rates. This is visible from the expectations embedded in the swap market. If you look at the graph, the gray line shows where the expectations were at the end of 22, and the blue line shows the decline in interest rate expectations which we face currently. And equally importantly, the central bank cut the key 2-week rate by 25 basis points at the end of December. We expect another cut in the upcoming meeting of the central bank on 8th of February, and we estimate that the cut could be 50 basis points this time around. Now, if we turn page to page 7, brief view of the relevant banking market. If you look at the deposit market, it reached 6.4 trillion crowns and expanded throughout the year by nearly 15%. Moneta overperformed in terms of growth the market rate, namely being successful in deposit gathering on the retail front, where our performance came in at above 22%, which is almost 3 times the market growth. We also posted fairly solid performance in our view on the commercial deposit market, even though we do not have large corporate customers. We managed to grow at 11%, which is roughly 1/2 of the overall market growth. Now, if we turn page, we look at the lending market. Interestingly, despite the relatively negative performance of the economy, which we can call stagnation, I suppose. The lending market grew at 6.4% and reached a level of nearly 4 trillion crowns. Moneta, in this respect, is a laggard. We contracted the retail book at 3.8% against the market growth due to our very defensive pro-cyclical stance based on our expectations of how the economy will perform. Nonetheless, on the commercial side of things, we managed to post a slight growth, which is driven by focusing on small business and high-value products in terms of margin, both margin and return on equity, and this will be visible from later part of the presentation. So with this respect, I will turn over to Andrew Gerber, who will summarize for you evolution of our digital and branch-based operating platform.
Thank you, Tomáš, and good morning, ladies and gentlemen. So moving to page 10, I'll start with an overview of the digital platform, which has become a critical distribution and service channel for the bank. Overall, 99% of retail wire transfer transactions are conducted via the digital platform. In 2023, we delivered 64.7 million payment transactions through the channel, up 17.7% year over year. And in terms of servicing, 18.7 million servicing transactions went through the digital platform, up 41.2% year over year, which reflects our continuous build out of the servicing capability within the digital platform. In terms of sales transactions, the digital platform delivered 670,000 unit sales transactions. This was stable year over year, which reflected slightly weaker performance in terms of lending, which, as Tomáš described, was the result of our more circumspect positioning with respect to the lending market. In terms of users, the digital platform stands at 1.4 million users, which is up 12.8% year over year. We have available for sale on the platform 29 products, and this we continue to build out as we go. And the mobile banking platform continues to be regarded as one of the best platforms in the market, with 45 awards received since 2016. Moving to page 11, you can see that the digital channels become a key enabler for product sales and a strong complement to the branch network. There are a number of key areas where the digital platform is now the primary sales channel, and there are a number of areas where we continue to make progress. I think the one area that's not on here is mortgages, where branches continue to play an important role. But even there, we're seeing our online platform start to gain significant traction. Going on to page 12, you can see that the digital platform users grew almost 13% year over year. And this was driven by rapid growth in mobile banking. What we see is that the internet banking platform as a standalone platform is declining, and more users are either using mobile exclusively or more frequently using a combination of the two, where there are also occasional users of internet banking. And this is evident on the right-hand side of the page when you look at the transactions conducted through the digital platform, which grew 17.5% year over year, with mobile now accounting for 78%. So we continue to see shift in actual transaction volume into the mobile platform. Moving to page 13, we look at some of the achievements in 23 and the priorities for 24. I'll just touch on a few, and I think the most important in a way is in the title, which is that the digital platform attracted 47,000 new-to-bank clients. We've been very successful with this platform in the past as a cross-sell platform for existing clients, but it's always been our objective that it should also play a role in acquisition of new clients. And in 23, 35% of the new clients acquired for the bank came through the digital platform, which I think shows the progress we're making there. In terms of other highlights in credit distribution, we had 110% growth of fully online distribution of commercial credit cards, which I think is a great success, and it demonstrates that we now have found a proposition and a distribution platform for credit cards that really works for distributing them online. And this is something we will continue into 2024 and have expanded into the retail segment as well. And I think no presentation these days is complete without some reference to AI. So here I would say we're kind of at the beginning, but we did run some pilots last year. Most importantly, we are experimenting with AI as a way of streamlining operational processes within the bank. And we ran a pilot on screening of investment calls, which we have an obligation, a regulatory obligation to do. And this looks relatively promising. So we're optimistic that there are opportunities to streamline the operation using new technologies. So looking forward to 24, I think naturally deposit repricing is a critical area for us. And here we're focused on personalization and automation of retention. This is really developing more sophisticated pricing strategies for the deposit portfolio as we reprice it. We would like to transform our online currency exchange into a full 24/7 service. We experimented in 23 with extended opening hours on the service with pretty good results. So we think there's an opportunity there. And finally, in the context of our overall distribution strategy, I'll mention the omni-channel mortgage platform, where what we're planning to do is to take the online platform, which we've developed and which has been fairly successful, and adapt that in order to allow it to be used also for branch distribution, with a view to allowing clients to move seamlessly between the two channels. I think this is particularly important in light of our distribution strategy, where in the fourth quarter last year, we took the decision to step back from distributing through brokers who were particularly important for the mortgage market. And our ability now to get the branch network and online working together will be critical to our strategy going forward. So on that note, moving to page 14, I'll briefly cover the branch network, which continues to play an important, however, decreasing or diminishing role in distribution and service for the bank. In terms of branch visits, we saw 1.1 million visits last year, down 5.1%. Cash transactions decreased 18.4%, and other payment transactions down 8.5%. On the other hand, in terms of loan applications, we saw 382,000 loan applications via the branch network. This was growth of 7.5%. The number of branches ended the year at 134. This is down 19 units since the end of the previous year. And in terms of staff deployed at the branches, we had 1,143, a decrease of 6.5%. So hopefully that provides a reasonable overview of the operating platform of the bank. And with that, I will hand over to Jan Friček, who will take you through the profit and loss development.
Thank you, Andrew. Good morning, ladies and gentlemen. I will now continue with the profit and loss statement, starting on page 16. Let me repeat the key financials. In 2023, Moneta delivered net profit of 5.2 billion and earnings per share of 10 crowns and 20 haléř. A return on tangible equity stood at 18%. Operating income of 12.1 billion was delivered on a basis of 14% growth of net fee and commission income, accompanied by other income higher by 440 million year-on-year. On the other hand, net interest income declined by nearly 8%. Our cost base reached 5.7 billion. This is only marginal increase of 2.4% year on year, and this is significantly below the inflation reported for the whole economy. Cost of risk line shows slightly higher charge in 2023 against the 2022. However, this is significantly below our original expectation, delivered based on continuing solid loan portfolio quality amid the benign environment, and supported from gains on NPL disposals. Net profit line significantly benefited also from a lower effective tax rate from 19.4% to 14.9%, resulting from our previous investments into Czech government bonds, generating tax-free income. On page 17, we can continue with the net interest income drivers or analysis in more detail. Year on year, we report a decline of 7.9%, driven by elevated cost of funding, only partially offset by improved interest income from lending, together with better interest income from treasury operations. Quarterly development is reported on the right, and here you can see in the top two charts that both interest income from lending as well as income from treasury operations shows improving trend during the whole year. If we look at the fourth quarter, in total, these two categories delivered by 1,450 million better result than in the last quarter of 2022. And here, let me remind you that since the fourth quarter of 23, we lost the remuneration on minimum deposit reserves in the central bank, which cost us about 120 million in the fourth quarter. Interest income on customer deposits shows increasing trend as well, however, at slightly lower pace of 1,370 million if we compare the fourth quarter of 23 against the year before. Hence, in total, this shows improving trend of net interest income on quarterly basis during the year. On the following two pages, we provide more detail of net fee and commission income development. Year on year, we report better result of 14%, in total 2.6 billion in 2023. And this improvement was delivered predominantly due to commission income growth of 40%. In the chart on the right, you can see more detail. If I start from the top, commission income from distribution of third-party products of 40% year on year was supported by improving result in distribution of asset management as well as insurance products. Fee income shows broadly stable development on quarterly basis during the year, and increasing trend of fee expense is in line with the higher transactional activity of our customers. Here, the low fee expense reported in the last quarter of 2022 was supported by extraordinary bonus we obtained from our partner. And on page 19, we provide more detail to our performance in distribution of third-party products. If I start on the left with the asset management, during the year, we expanded the portfolio of distributed investment funds by 37%, and at the end, the position stood at 38.5 billion Czech crowns. Here, the driver is significantly elevated distributed volume in the fourth quarter amid improved demand for the investment products, and this positive trend is visible or continues in January of 2024. Below that, you can see that the commission income generated by the asset management improved by 9.6% and reached 330 million in 2023. And the top chart on the right side shows 52% growth of the commission income from distribution of insurance products, where the main driver was improving result of distribution life insurance together with the pension insurance products, where we achieved improved commercial conditions and also strengthened the distribution capacity. And we complete this section with the cost base reported on page 20. As I said, only marginal increase of 2.4% year on year, or 140 million in absolute amount. This increase, comparing to double-digit inflation in the economy, we perceive as fairly decent result, demonstrating cost discipline of the bank. And moreover, about 2/3 of the increase are driven by higher regulatory charges. Besides that, we maintained the personal cost stable year on year or slightly below the 2022, where the higher or increased average salary was fully funded by improved productivity. And quarterly development on the right shows a seasonality or volatility between the quarters, and this has several drivers. First of all, annual regulatory charges are accrued in the first quarter. On the other hand, the variable performance bonuses we typically accrue only in the last quarter. And the third driver is different marketing effort and other initiatives during the year. So that was all to profit and loss statement. And with that, I will hand over back to Andrew to continue with the balance sheet. Thank you.
Thank you, Jan. So if we may move to page 22, we have a high-level view on the balance sheet development, where you can see stable lending with increasing yields and strong growth in the funding base, resulting in higher cost of funding. Overall, net customer loans decreased 2.1%. And as Tomáš said earlier, this was driven predominantly by retail and in turn by somewhat higher pricing as we sought to reflect the higher cost of funding, and also tighter credit underwriting criteria as we sought to reflect the general macro environment. Towards the end of the year, some of those pressures started to ease up, and we've been able to price a little bit more aggressively starting in December. And to slightly improve approval rates. So we will see how that develops over coming months. With respect to yield, you can see that the loan portfolio yield increased 44 basis points year over year. This was driven predominantly by retail, by repricing of the commercial loan portfolio, where a significant part is on floating rates, and to a much more limited extent by repricing of the mortgage portfolio, where the refixations are much slower to roll through. In terms of the funding base, we grew 20.1% year over year. And as Tomáš said earlier, this was driven predominantly by strong development in retail deposits, although this also brought significantly higher cost of funding, up 167 basis points year over year. So if we move to page 23, we present a more detailed view of the balance sheet development. The balance sheet expanded by 458 billion, as we said, driven by strong deposit growth. On the asset side of the balance sheet, you can see net customer loans are down slightly, whilst investment securities and cash and balances with the CNB increased significantly. On the liability side, you can see the growth being driven by customer deposits, which are up 19.6% year over year on the back of our deposit gathering strategy. Moving to page 24, we present the detail of the loan portfolio development, where the loan portfolio decreased in line with the plan due to lower mortgage volumes and generally cautious lending approach. As I said earlier, the portfolio decreased 2.3%, where retail was down 3.8%. Small business continued to perform well, up 11.8%, driven by our automated lending products, and SMEs more or less stable. On page 25, we present the yield development of the loan portfolio. Overall, the loan portfolio yield was up 50 basis points. As I mentioned, this is driven predominantly by by repricing of the commercial portfolio, which was up 80 bips, and to a lesser degree by retail, where you can see the portfolio yield was up 30 bips year over year. On page 26, we present the detail of the deposit portfolio, which delivered growth of 70 billion in incremental funding, which helped to support stabilization of net interest income. Overall, as we said, the portfolio was up 20.1%, with retail growing 22.2%, commercial 11.1%, and wholesale up 33.1%, where key driver there was the subordinated term deposit, which we distributed. Finally, on page 27, we present the cost of funding development, where the growth in cost of funding has decelerated in both retail and commercial over the latter part of the year. Overall, the cost of funds increased 93 bips year over year, and this is more or less reflected through the segments, with the exception of commercial, where the increase was slightly slower at 68 bips. So overall, I think it was obviously a very strong year in terms of deposit gathering, more of a transitional year in terms of the lending business. However, I think going forward into 2024, obviously our big challenge now is managing the deposit portfolio and the repricing of the deposit portfolio, and this is what we will focus on now. So with that, I will hand over to Jan, who will take you through the liquidity development.
Thank you, Andrew. Before we go into the detail, let me summarize key liquidity ratios reported on page 29. Incremental liquidity, which we obtained or gathered during 2023, significantly strengthened our liquidity position, which is visible on all key ratios. If I start with loan-to-deposit ratio, here you can see a decline by 15 percentage points to 66%. And on the right, share of high-quality liquid assets on customer deposits increased to 40%. Below that, net stable funding ratio stood at 164% against the regulatory limit of 100%, and liquidity coverage ratio ramped up to 354% against 100% regulatory limit. On page 30, we provide in detail development of high-quality liquid assets. As you can see, at the year-end, we reported a position of 160 billion, which represents 86% year-on-year, or 74 billion in absolute amount. And about two-thirds of the incremental liquidity was invested into government bonds, and one third remained placed with the Czech National Bank. On the next page, we provide interest rate sensitivity of our balance sheet. It is page 31. The incremental liquidity increased the share of assets and liabilities at the variable interest rate in 2023. If we look at the asset side, here the share increased from 32% to 46% and stood at 201 billion at year-end, against liability side, which increased, where the share increased from 51% to 58% and stood at 242 billion. These assets and liabilities can be repriced within 3 months, in line with the market rate change, contractually repriced within 3 months, with one exception, and those are savings accounts. 194 billion of savings accounts are repriceable within 3 months as well, however, based on the management's decision, without the direct link to market rate development. We also recalculated simplified NII sensitivity on the static balance sheet, and this shows, or this estimates, that 100 basis points decline of the market rate would improve our top line by approximately by 400 million on annualized basis. And this assumes full reflection of the 100 basis points market rate drop on asset side as well as on the liability side. On page 32, we continue with the repricing or repayment profile of our loan book. Out of 264 billion loans, 22 billion are exposures at variable interest rate, 84 billion are at fixed rate till maturity, and nearly 158 billion are at fixed rate till the end of refixation period. Those are mostly mortgages. On the right side, you can see that about half of the loan book, or 48% precisely, will be repriced or repaid within the next 24 months, and 3/4 will be repriced or repaid within the next 36 months. And if you flip the page, we provide a similar view on our customer deposit base, where out of 399 billion, 53 billion are term deposits, 252 billion are savings accounts, and 94 billion current accounts. On the right side, you can see that 57% of the deposit base, or 230 billion of deposits, are eligible for the reprice within 3 months. And on the other hand, about 1/3 of the deposit base provides limited capacity for a reprice down due to already very low pricing. So that was all to the liquidity management, and I will now move on to the capital management section starting on page 35. Firstly, let me summarize capital ratios on consolidated level. Capital adequacy ratio stood at 20.1% at year-end against management target of 16.1%. And also Tier 1 capital adequacy stood at 15.7% above management target of 13.2%. On both, you can see an improvement in the level against the comparing position a year ago. 9 crowns per share as a proposed dividend corresponds to dividend accrual of 4.6 billion, which we reported at the end of 2023. And as was said, this is by 12.5% the higher position than accrued at the end of 2022. And lastly, our excess capital reached 4.25 billion at the year-end, which is by 15.6% higher than we maintained at the end of 2022. On page 36, we can continue with the detailed decomposition of our capital requirements on both individual and consolidated level. Let me start with the consolidated level reported on the left. There, our capital requirement stood at 15.1%, management target at 16.1%, inclusive of the management buffer of 1%. And since the 1st January of 2024, our management target decreased by 30 basis points, resulting from lower Pillar 2. On an individual basis, we have to cover also the MREL requirement of 6.6%. Hence, the management target is higher. It stood at 22.7% and remains stable for the first quarter of 2024. The lower Pillar 2 by 30 basis points will be reflected only in the second quarter this year. Hence, the management target will decline to 22.4% on the individual level. And let me continue on page 37 with the detailed view on capital position on individual basis. Here our regulatory capital and MREL instruments in total stood at 38.4 billion. This is by 8.9% above the position reported at the year end of 2022. where the growth is driven by successfully distributed subordinated deposit issued in June and July of 2023. Decline in risk-weighted assets density is driven by higher share of liquidity in the balance sheet, and the MREL adequacy ratio stood at 24.1%, which is by 1.4% above our management target. In total, the liquidity or the capital position provides sufficient access, enabling to increase the proposed dividend payout from originally targeted level 80% to 88%. And let me complete this section with the consolidated position, where regulatory capital reached 33.6 billion at year-end. Also, risk-weighted assets density decreased, and Tier 1 capital adequacy ratio stood at 15.7%. This is the most important ratio from the dividend capacity point of view, where the excess capital stood at 2.5%, which in absolute terms corresponds to 4.25 billion. This is on top of the dividend accrual of 4.6 billion. And last comment, let me highlight that the Pillar 2 reduction hasn't been reflected yet. Hence, since January 2024, the excess capital has increased by additional 500 million. With that, let me hand over to Norman, who will walk you through the risk section. Thank you very much.
Thank you, Jan. Good morning. We are now on page 40 with an overview of key risk performance metrics. Let me start on the top left and then clockwise down. So the cost of risk ended up with 305 million Czech crowns, or 11 basis points. This is well below the initial guidance early last year, but also well below the last guidance we provided to you in the autumn of 15 to 35 basis points. The key driver, I would say, is a solid core performance, NPL disposals, and to some extent still upgraded forborne receivables from the past. The difference to 22, where we still had a very, very low cost of risk of 3 basis points, is driven by a very huge amount of upgraded receivables from the COVID period. And since that portfolio is coming down, we didn't have the same benefit in 23. With regard to loan loss provision coverage and NPL coverage, both ratios came down for similar reasons, namely the NPL disposals and the upgrades of previously forborne receivables. And as far as the non-performing loan ratio is concerned, this stayed flat year over year and stood at 1.4% at the end of December. Turning the page to page 41, here we have a more granular view on cost of risk, a quarterly view in the last 2 years, and also a segmental view. In the retail lending space, we recorded a cost of risk of 140 million, and in commercial, 160 million. Within the 160 million commercial, there's almost half of that amount is attributable to one single commercial default. If not for that, needless to say, the cost of risk would be lower. Non-performing loan sales continue to play a fairly important role in our collection strategy. So in 2023, we executed debt sales in the amount of 1.2 billion, recording a pre-tax profit of 307 million, which was even a bit above the amount we generated in 22. Going to the next page, page 42. Here we have an overview on the evolution of our gross loan receivables and the loan loss provisions and related metrics. So the gross loan portfolio dropped year over year by around 6 billion, whereas the loan loss provisions and the coverages dropped year over year. If you look at the top right box, and in particular Q4, here you will notice we have reduced the management overlays from above 900 million to 643 million. This is a result of a back testing exercise of our management overlay framework, as we have seen that some of the risk metrics we anticipate to see in the second half of the year did not materialize, which made us conclude that an adjustment of the overlays is necessary. The non-performing loan portfolio on the top left, the stock, only increased by a small amount, by roughly 60 million, so almost stayed flat year over year. When we move to moving to page 43, here you have an overview of in and outflows of NPLs. As said, the year-over-year comparison shows a fairly flat picture. In Q4 23, here we saw a net NPL formation of 329 million. This increase is almost entirely driven by one single commercial client default. If not for that, we would actually see a drop between the end of September and the end of December. And the last page, page 44 of the risk section, here we have an overview of delinquency ratios 30, 60, and 90 plus. As is clearly visible, we still have a level significantly below the COVID and pre-COVID period. Already in the beginning of last year, we actually expected increase of delinquencies, which did not really materialize through the year. Only at the end of December, after Christmas, we saw here an increase, not a big one, but we saw some increase, which is already partially rolling back. We obviously will carefully monitor this development. It's clearly a function of the macroeconomic indicators, unemployment rate, but for the time being, it still looks fairly low compared to the past. So summarizing the risk section, I think we can say we have seen another quarter with solid core performance, despite all the challenges associated with the current macroeconomic environment. As a result thereof, we were able to partially release some of the allowances we booked under the ECL management overlay framework. That release, together with the successful NPL disposals, contributed to a lower than expected cost of risk result. Having said so, we, however, remain cautious and prudent in our provisioning approach and will continue to monitor the credit portfolio performance as well as the development of key macroeconomic indicators. And with that, I hand over back to Tomáš on the updated market guidance. Thank you.
Bear with us for a couple more minutes. The last part of the presentation contains outlook and market guidance. So beginning on page 46, we provide you with a view of last 5 years and how we see the upcoming 5-year period in terms of net profit of the bank. So the last 5 years, we made 21 billion. If everything comes through, we aspire to deliver on a minimum basis 27.7 billion in the following 5 years. With respect to the near future, for the current year, we would like to deliver likewise 5.2 billion, and then move up the earnings as we reprice both the deposit and the loan book, as we had presented during Honza Friček's part of the presentation. If you then turn to page 47, here we have a more granular view of what are the minimum financial targets for the bank concerning operating income and all the lines on the P&L. I will not really comment this apart from the fact that the operating line on CAGR basis should grow at 4%, and the net earnings or profitability of the bank should grow on a 3.6%, being impacted by slight growth in the operating expenses, and of course, evolution of the cost of risk line, which we have modeled somewhere in midpoint of these ranges. So this is the more granular view of the financial targets against which we will report. On page 48, you have our assumptions underpinning the medium-term plan. With respect to the current year, we have GDP growth of 1.2%, which is below the official estimates. We have increase in unemployment. This assumption obviously drives potential increase of the cost of risk. Inflation, we take from the official sources being arrested at 2.6%, which might be a bit optimistic assumption. And the average short-term rates, both the repo rate and PRIBOR, are modeled to produce annual average of 5.2 and 5.4% respectively. And you also have our assumption regarding the euro crown exchange rate, and you can see the other figures for yourself. I will not comment it for the sake of time. On page 49, we have loan growth aspiration, and we see you can see that the plan is somewhat conservative and careful, where the current year should see an expansion of the loan portfolio by less than 3 billion. This is due to our continued strategy to focus on profitability of the mortgage business, which is projected to somewhat decline, and higher effort on the other retail lending categories. We project a relatively good growth on the commercial side, and this is really being underpinned by continued expansion of lending franchise to the small businesses, which is from capital return, our currently most profitable activity that we have in the bank. With respect to deposit gathering, we considerably slower the growth which is embedded in this plan. The overall deposit position on 5-year basis should grow at 4.6% in the current year. This constitutes increase of 15 billion, as we continue to place emphasis on having adequate liquidity and continue to act in that way. Nonetheless, the guidance calls for profitability improvement on a 5-year cumulative basis of 27%, and we hope that we will be able to deliver it, surmount the current and future challenges that the bank may face. We very much thank you for your attention, and now we turn over to you, and we will answer your questions.
Thank you. We will now begin the Q&A session. If you'd like to ask a question and have joined the call via Zoom, please write it to the chat in the browser or use the raise hand function on your screen. Before speaking, please make sure that your local device is unmuted. Once your question is answered, please cancel the raise hand function. Additionally, if you've joined via the telephone lines, please dial star followed by 1 on your telephone keypad. Our first question comes from Mikhail Butkov of Goldman Sachs. Mikhail, your line is open. Please go ahead.
Good day. Thank you very much for the presentation. I have a couple of questions. Firstly, it was made a comment on Bloomberg that Moneta may consider increasing the payout ratio to 90%. So can you confirm this? And if so, how do you think in balancing the capital allocation between the dividend payout ratios and the growth, especially when the market conditions may allow for the faster growth, for example, when the rates will come down? So this is the first question. And the second question, I noticed some changes in the guidance for the medium-term outlook. Obviously, it was well explained on cost of risk, I guess, but on the operating income, it seemed that the lower end of the guidance now is a bit lower than it was in July. So can you also walk through the reasons, the components for that? Thank you.
If you look at our business plan, which we incidentally must submit to the central bank, we plan to accrue for 90% dividend payout. This is subject, it's not a guarantee. This is the intended strategy of the bank, given the fact that we currently have 4.25 billion of excess capital, which will increase to an estimated amount of 4.75 billion in the second quarter of this year. So we have ample capital resources to support the growth of the balance sheet as it is modeled. Should we see more opportunity to expand the loan book, we will adjust that policy in order to accommodate the growth of the balance sheet. But this is right now, this is the policy. And the medium-term outlook, you are correct. The operating income is lower, and it's chiefly due to the fact that we had suffered decision by the central bank to discontinue paying interest on mandatory reserves. And that impact was publicized at level of 450 million for the current year. Last year, that impact was 120 million in the fourth quarter. Hence, we've adjusted net interest income projections based on the new reality.
Okay, thank you. Just to clarify on dividends, so this 90% we speak about this year, or it is, or it was this comment was made with regards to the medium-term payout guidance.
This comment was made with regards to both.
Okay. Thank you. Thank you very much.
Thank you. As a reminder, if you've joined via Zoom, please use the raise hand icon on your screen or the Q&A chat box. And if you've joined via the telephone lines, please dial star followed by 1. Our next question comes from Mehmet Sevim of JP Morgan. Mehmet, your line is open. Please go ahead.
Good morning. Thanks very much for the presentation. I had one question about the deposit base and the deposit repricing going forward, given you mentioned this is one of the main challenges going forward, particularly with regards to the deposit base that you've recently gained. What strategy will you follow there? Would you let some price-sensitive deposits go again when rates come down? And are you otherwise hoping to keep that excess liquidity even with LDR now at just 66%? And maybe related to this, how are you actually seeing loan growth dynamics this year? Obviously rates have started to come down, but I assume things are still somewhat muted. So when would you expect a recovery there, and from which portfolios, and maybe also going forward in your medium-term guidance, what kind of loan growth numbers are you baking in? Thanks very much.
I'll take the easy question, and Andrew will take the difficult one. In terms of loan growth, you have to figure highlights of the business plan in the in the guidance, and this reflects our current appetite. What we are seeing currently is very significant. The trending in January is actually we are outperforming last year by margin of 60 to 90%, depending on categories. And this development is taking place in the retail or small business unsecured category. So we are seeing a very, I would say, robust start of the year, and the plan obviously has a margin, as a conservative margin, so we could come in better. But for all it's worth, it reflects our thinking from November and December. And Andrew will give you a more flavor on the deposit repricing.
Yeah, so I mean, with respect to deposit repricing, the overall answer is that we intend to hold on to the deposit balances, and again, you can see that in the guidance on page 49. There's some growth anticipated this year, albeit much slower than last year. I think our deposit strategy was built on being competitive, being relatively aggressive to the market, and targeting the growth. And now in the repricing, our intention is to maintain a relatively competitive position and to protect the balances. So this is obviously an evolving area, because we've just had one rate cut. There's another central bank decision on the 8th, and we will see how the market responds to that, and what implications that has for us. But we have a clear strategy here that we want to follow, and now we will see how it plays out.
Great. Thanks very much, Thomas. Thanks, Andrew. Can I maybe just ask on the second point as a follow-up? Could you able to give us some flavor on how this integration of those newly acquired customers is going, essentially offering them new products and integrating them into the Moneta suite of products? So are these customers mainly using those deposit accounts mainly as a savings tool, or are you actually seeing them using your current accounts now, using your fees, maybe getting loans? Any flavor you would have on this point?
Go ahead.
Okay. One thing to be clear on is that the growth that we were able to generate in 2023 came through a combination of newly acquired clients and bringing more money to the existing clients. So as with all banking markets, most clients in this market have multiple relationships. So we benefited hugely from the growth on the existing base. And yes, we also acquired new clients through the deposit proposition. These clients are typically onboarded with a current account, savings account, and the mobile banking application. So this is a good start, because we have all the prerequisites for the relationship. But it's still too early to draw conclusion as to whether we will be able to deepen those relationships and achieve the kind of cross-sell that we have achieved in the long term on the rest of the client base. What I would say is that we're not under any illusion that when you go to the market with decent pricing on deposits, you obviously bring some of the hot money, and that's why our deposit repricing strategy is very sensitive to that reality.
And nonetheless, what we are observing is that the purely opportunistic relationships that are drawn by the fair, good, or competitive value proposition is resulting in a rapid growth of our asset management distribution and pension fund distribution. So these are, I would say, the bright spots in the cross-selling strategy of the bank, which are visible from which are visible from the results of the bank. And it's namely asset management, where after a very difficult period with respect to the first half of the year, or rather first 3 quarters, we accelerated the sales on asset management distribution. We have effectively doubled our monthly sales of the funds that we offer. This trend continues through January because, again, we had a fantastic month, and we have very high expectations from investment advisors that we deploy in the bank. Their target for annual asset management distribution is higher, 60% higher than last year for the current year. So our strategy is pretty much hinging on ability with the declining rates to convert part of these deposits into a steady margin business on the asset management front. And it's too early to tell whether we will be successful in this.
That's super helpful. Thanks very much for the color.
Thank you. As another reminder, if you've joined via Zoom, please click the raise hand icon on your screen or submit your question in writing via the Q&A chat box. And if you've joined via the telephone lines, please dial star followed by 1. Our next question comes from Thomas Unger of Erste Group. Thomas, your line is open. Please go ahead.
Hello. Hi. Thank you very much for taking my questions. I would like to come back to your loan growth outlook, particularly for this year, and tying that together to the NII, the development that you expect. I think if I look at the previous guidance versus the current one, your loan growth outlook is a bit more optimistic now for 2024, likely due to the development in January that you just mentioned. But what do you expect for the NII and the net interest margin in particular for the coming quarters? Is Q4 2023 the low point? How do you factor in potential rate cuts and also the cancellation of the remuneration on minimum reserves, as you mentioned that multiple times in this call? Then secondly, I'd like to ask on the cost side, operating expenses, regulatory charges. Can you describe the cost pressure that you expect for this year and the measures that you will be taking to counter that? And then also, what is your expectation for the regulatory charges in the current year? Thank you.
Okay, Thomas. Jan Friček will correct me wherever I make mistake. But if you look at our projection for the next year, broadly speaking, the turnaround on the NII is to be expected in the second half of the year. The fourth quarter of 23 is certainly not the trough, because you have double whammy of number one, the discontinuation of payment on the mandatory reserves, and second, you have declining short-term rates. So we will have to catch up through a repricing action on the deposits and catching up in our case, where we are the David fighting the Goliath of the large banks. We have to put some time lag in how we adjust pricing on the deposits. So we have to play this very carefully. So simply put, you should see stability and growth in the NII in the second half of 2024. The second question, the second part of the question. On costs. In September, or rather October 22, we said the bank will have 2,500 FTEs. As of last week, we are at 2,503. We have said that we will close branches and undertake restructuring, and we were the only bank in the Czech market to start that early, and we've delivered all of what we've committed. If you look at the cost base, it is to grow by 100 million. So there is some margin. There is some margin there for error. Nonetheless, we expect to keep the efficiency of the bank through cost discipline, going forward. We expect pressure from suppliers, and we try to concentrate whatever we can to negotiate better cost positions. We have subleased by now, or effective February, we have subleased effectively close to 25% of all of our head office space concerning Ostrava operation and Prague. So we have a AAA tenant moving into the building, and we have done a lot to position the bank against the strong headwind. I hope that we will be able to maintain the cost confidence.
There is one more element or assumption underneath the projection, and this relates to regulatory charges, where we expect a reduction of 70 million, which is the combination of not paying again the one-off due to the Sberbank failure, and also a resolution fund has been fulfilled to the level that the contribution should go down. So 70 million decline is included in the projection.
And the 70 million cost alleviation had been projected into the plan for 24. So you could say it's risky. We don't know whether it will materialize, but from a moral viewpoint, it should certainly materialize, because there's no need to continue paying. So we will see.
Right. Thank you very much.
Thank you. As a final reminder, if you'd like to register a question via Zoom, please use the Q&A chat box or the raise hand function. If you've joined via the telephone lines, please dial star followed by 1. At this stage, we have no further questions, so I'll turn the call back over to Mr. Sporny for any final remarks.
Well, we have behind us a year which we consider successful in the ability to match the 2020 result despite of pressure on the NII. We have successfully, thanks to Andrew, executed our strategy on net fee commissions. Norman did a fantastic job on managing the cost risk, because we had obtained the gain on disposal of NPLs. So if I may put some personal remark into it, we have raised the bar. We have raised the bar by delivering 5.2 billion, and the target for 24 is likewise, and it's a minimum target, 5.2 billion. I believe we will achieve it in due course. We have significantly improved the sustainability of the business model with respect to liquidity management. Honza Friček implemented a backstop liquidity facility, which we can use with central bank, which, if under pressure, we are able to raise 70 billion through our mortgage-backed securities, which is a great, let's say, accomplishment to keep the bank safe. in the current year and upcoming years. We have also successfully exited from very low, however, currently difficult exposure to polyfunctional or fully office-based projects, financing of these projects. So this contributed to decline of the loan book. Clara, who is here with us, but she's not visible to you, from Chief Operating Officer perspective, have put together a number of improvements on the IT operational and incident resolution side. And we feel that we are progressing against the medium-term plan on improving, solidifying our IT capabilities, skills, inclusive of cybersecurity protection of the bank. And on ESG, we will publish the sustainability report, and I believe we are broadly on track with the ESG activity. So I want to give my sincere thanks to the management and the staff of the bank. I'm very happy with the result, and I'm deeply grateful to everyone who works with us, who works with Moneta, building it up. Thank you very much, and I look forward to report the first quarter of 2024. Have a good day and have a nice weekend.